Welcome to my podcast, Money Conversations with Maya. If you watched our last episode, you'll remember we spoke about why so many people invest for years and still don't feel wealthy. We touched on something important there, that investing isn't just about products or returns, it's about structure. So today, we're continuing that conversation and making it concrete. We're going to break down the 4 pillars of investing, the foundation that quietly determines whether wealth actually gets built or not. If these pillars are clear, investing feels calmer. If even one is missing, investing feels confusing, no matter how long you've been doing it. Hey Alex, welcome back. So last time, you said something that really stayed with me. You said you'd been investing for years, doing the right things, but still weren't sure what actually mattered most.
Hi, Maya. Thanks for having me again. Yeah, and after that conversation, I kept thinking about it. It made me realize how much of investing advice comes in pieces, tips, rules, strategies, but never the full picture.
Exactly. Most people don't fail because they lack discipline. They fail because they never see the framework behind investing. That's what we're going to walk through today. Let's start with the pillar most people completely underestimate, income. We often talk about returns, markets, and investments, but income is the engine that feeds everything else. If income doesn't grow, investing has a ceiling, no matter how disciplined you are. Here's a simple example. 2 people invest in the same market with the same strategy. One grows their income over time, the other doesn't. 10 years later, their outcomes look very different, not because of investing skill, but because one had more fuel. Most people try to fix slow progress by chasing better investments. But very often, the real constraint isn't returns, it's income.
When you explained income as the fuel for investing, it really reframed things for me. I think a lot of people, including me, focus so much on optimizing investments because it feels more sophisticated. Working on income feels slower, less glamorous. But when I look back honestly, and the biggest improvements in my financial life didn't come from better returns. They came from moments when my income increased or became more stable. And I never really connected that directly to investing before. More income means more investing. That's interesting. I've always thought of income as separate from investing.
Most people do, but income is the foundation everything else is built on. The second pillar is risk, and it's probably the most misunderstood. Risk isn't just about losing money. It's about how much volatility you can live with, emotionally and practically. 2 people can hold the same investments and experience completely different stress during a market fall. Risk isn't only in the portfolio, it's in you, your temperament, responsibilities, and stability. Ignoring this pillar is why people exit at the worst possible time.
The risk part hit home for me too. I always thought of myself as someone with a high risk tolerance because I understood markets intellectually. But emotionally, that wasn't always true. During drawdowns, I noticed myself checking prices more often, second-guessing decisions, and feeling uneasy, even when I knew, logically, that volatility was normal. It made me realize that risk isn't just about what you know. It's about how you actually react when things don't go as planned. That explains a lot. I've definitely reacted differently in bad markets than I expected.
Exactly. Understanding risk doesn't remove volatility, it helps you survive it. The third pillar is asset allocation, where your money actually sits. This matters far more than individual stock or fund selection, but it gets far less attention. Most people think they're diversified, but they're actually just scattered. Buying multiple investments that all move together isn't diversification, it's repetition. Allocation determines how deep drawdowns feel, how fast recovery happens, how much stress you experience. It's about how differently those investments behave. If everything moves up and down together, it doesn't really matter how many things you own. This is why 2 investors with similar returns can have very different experiences. One sleeps well, The other feels anxious all the time. That difference often comes down to allocation.
That actually explains something I felt but couldn't articulate. I've had periods where my investments were doing fine on paper, but I still felt uncomfortable. I kept thinking I needed better picks, but maybe it was the mix itself that didn't suit me. So it's not about owning more things. It's about owning the right mix.
Exactly. Allocation quietly drives outcomes. And that brings us to the fourth pillar, behavior and time. This is the part nobody likes to talk about because it doesn't sound exciting. Everyone says they're a long-term investor. Very few people actually behave like one. Most investing plans don't fail during crashes. They fail during boredom, when nothing happens, when progress feels slow, when comparison creeps in. That's when people start changing strategies, second-guessing themselves, or abandoning good plans. Time only works when behavior stays consistent. Compounding doesn't need brilliance, it needs patience.
That's honestly the hardest part. Not knowing what to do, but sticking with it when it feels unrewarding. I think a lot of people underestimate how emotional investing actually is.
Exactly. That's why this pillar matters as much as all the others. And that's why these four pillars work together. Income determines how much fuel you have. Risk determines how much volatility you can live with. Allocation determines how your journey feels. And behavior determines whether time can actually do its job. If even one of these is ignored, investing starts to feel stressful or confusing. But when they're aligned, investing feels calmer, even when markets aren't. One reason I wanted to talk about these pillars together is because most people feel like investing is something they're bad at. They assume they're missing intelligence or discipline or some secret strategy. But in reality, most people were never shown a structure. They were shown products, they were shown performance, they were shown outcomes. Without a framework, everything feels confusing, even when you're doing reasonable things.
That's true. It's comforting in a way, realizing the problem wasn't personal failure, but missing context.
If someone is listening to this and wondering what to do next, I want to say something important. You don't need to fix all four pillars at once. Sometimes the value is simply noticing which pillar feels weakest right now. Is it income that feels constrained? Is it risk that feels uncomfortable? Is it allocation that feels chaotic? Or is it behavior, constantly changing direction? Clarity starts by asking better questions, not by making faster decisions.
That actually changes how I think about taking action. It feels less urgent and more intentional.
Exactly. Calm understanding always comes before confident action. Before we wrap up, I'd really love to hear from you. Money means different things to different people, and there are so many directions these conversations can go. If there's a topic around money or investing that you'd like me to cover in future episodes, please leave a comment below and let me know. I read every suggestion, and your ideas will help shape the conversations we have here. If you enjoyed this conversation and want to hear more calm, honest discussions about money, please like this episode and follow the channel. We release new money conversations every week. Thank you for being here.